Estee Lauder is at its 52-week low, currently down 32% year to date. But is it a buy now? Is now a great opportunity to lock in that nice yield of 1.53%, get a higher yield on cost as the years go by, and really get that share price growing and making some good capital appreciation. Today we're going to take a look at the historical performance of the Estee Lauder company. We're going to take a look at their revenues year on year, see their growth rates, look at that bottom line, that net income. We're going to jump into their balance sheets, look at their cash versus their total debt. As always, we are going to take a look at that important dividend safety, some very important financial metrics for EL, and we're going to run it through our stock valuation model, getting to our intrinsic value, finding out our margin of safety given our acceptable buy price. Now, Estee Lauder is down 32% year to date. As we can see here, it is at that 52-week low, offers a yield of 1.53%. And for those shareholders who have been holding the company over the last 10 years, well, what we can see from here is that you'd be up 158% without dividends reinvested. So, not the worst, actually quite nice, 160%. And as we can see, it does really depend at which point you bought. But we can see here roughly that their essential all-time high is sitting at around $370, $380, which we saw at the end of 2021. So there is some significant upside if it is to break that all-time high. Now, in terms of their revenues year on year, typically we like to see 3 to 7% growth. What we can see here, June 2018, 13.7 billion reported in terms of their income statement, and then 5 years later, 17.7 billion. So it has been nice growth over the last 5 years, and we'll shortly look at the 10-year growth. Year on year, we can see some growth other than 2019 to 2020 when it did dip slightly, but then it did pick up from that point and has continued to grow. Now what we want to see is the direction of that bottom line. 1.1 billion reported net income in 2018, 2.4 billion, so over double 5 years later. But we can see here from 2019 to 2020 where the revenue did dip, so did their bottom line. But positively, it did pick up. We can see a slight drop here from 21 to 22. So some positives, but there are some things just to look out for that we will run through later. In terms of the cash versus total debt, June 2018, 2.7 billion on the balance sheet. 5 years later, in their latest quarterly report, 5.5 billion. So nice to see that cash and short-term investments balance increasing. And what we want to see now is the direction that their total debt has gone over the last 10 years. So total debt, June 2018, 3.6 billion, almost 3 times as much in their latest quarterly report at 9.6 billion. But it doesn't necessarily mean that that is a red flag indicator. And we are going to take a look now at that dividend safety and some important financial metrics. Dividend safety score 70, making it safe. Market cap 62.6 billion, making it a large cap company. Now, in terms of some recession metrics and some other key metrics that we will run through. So in the last recession, 07-09, they maintained the dividend. They didn't cut it, but they also didn't increase it. Whilst they had negative sales of around 10.5%, we can see this was effectively the average growth rate during the S&P 500's 07-09 period, which was also negative. And you could argue that essentially the recession return is effectively in line with the S&P's negative 55% for this period. So a mixed bag there for those that believe we are heading into a recession. And what we can see here, they have actually been paying increasing dividends for only 2 years. We can see some periods here where they did actually do a dividend cut. And as I always say, if a company does a dividend cut once before, they are likely to do it again in the future if they are really struggling. Latest increase in November last year, 10%. So very nice to see double digits. So hopefully this year in the next couple of months, we see another double digit increase. Then 5 years, again, another double digits at 12%, 17% for the last 20 years. So very positive to see, given the fact that they have cut their dividend a few times across the last 10 to 20 years. So very positive to see. As I always say, aim for at least 4%, as that was the US inflation rate over the last 40 years. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. So we have one sign here of undervaluation. And I just want to make an important note that we can see here over the period, over the last 5 years, this was in fact probably the highest dividend yield for Estee Lauder. Doesn't necessarily mean it's undervalued, but it is a potential sign, and we'll draw our conclusions at the end of the video, as we essentially never look at any model in isolation. Now, forward PE, slightly higher than the 5-year average, and in terms of the sector PE comparison, the consumer staples is significantly lower than Estee Lauder, which is currently just below 42. As I mentioned, bang on there at the 52-week low, but as always, 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, free cash flow payout over earnings. As always, earnings is susceptible to manipulation by management through accounting. So with the free cash flow, below 60% is what I always say. That's one of my 7 golden dividend metrics. Do go check my pinned YouTube video if you want to see the other 6. Now, in terms of what we can see here, for the large part, effectively, in fact, all of the last 10 years been below 60%, which gives me confidence in their ability to pay that double-digit dividend increases year on year. 2021, 25%, 2022, 42%, 2023 expected to be 49%, which is the second highest it's been over the last 10 years. So very positive in my opinion, and nothing to worry about so far. Free cash flow per share, again, is what we look for. 197 in 2013, 556 in 2022. Nice growth over the period. 2023 expected to drop slightly, which you could argue is the reason for that large drop in share price. But what I do like to see here is the fact that it is growing over the last 10 years. It is in that upwards trajectory, which is really good to see. Some companies we do review do either stay flat, or we can see some that are declining. So this is positive for an investment that you want to make. Now, sales growth, 3 to 7% is what I mentioned. 2015, 2020, they had negative growth. But other than that, they have been between that 3 to 7%, with some years, 2018 and 2021, significantly higher in the double digits. So it is positive to see. Around 10 billion of sales in 2013, around 18 in 2022, nearly double over the last 10 years, consecutively increasing their sales year on year. Very positive to see, in my opinion. Now, shares outstanding, returning excess cash to our shareholders by buying back shares. Not, I would say, anything huge. Consistently a couple million here every single year. Nothing to essentially talk about, and no real negatives, but nothing really to say is amazing. ROIC, again, another one of my dividend metrics. Above 10% is what we like to see to ensure management are able to effectively allocate their capital. 2021, 19%, 2022, 24%. Very nice to see. Double digits above that 10%. So it gives me faith in management and the way they operate. Margins above 12% is what we see, and this is typically in this industry where we can see some businesses struggle. Has effectively been above 12% fairly comfortably and consistently over the last 10 years. Likewise with that free cash flow margin, again above that 5% as a minimum that we look for. So very positive in my opinion. Now, this is one area that we had a look at earlier when we looked at the balance sheet. Net debt to earnings for interest, tax, depreciation, amortization, which can affect the dividend safety. Below 3 is what we look for. I mean, 2021, 2022, it would be less than a year for the company to pay off all their debt net of cash on hand. 2023, it is expected to rise to 1.1, but again, significantly lower than the 3 that we look for. So, very positive in my opinion. No worries for the dividend safety. And here we're purely saying 37% of the company's financing is from debt as opposed to equity. So fairly strong metrics in my opinion, 1 or 2 things to look out for. And as always, if you are enjoying the content, do hit that like button, do subscribe for more content on the channel. And if you want to run your own companies of portfolios through the model, do check the pinned comment and grab a copy. Now, Graham's valuation, we have the earnings per share at 3.05. Analysts estimating some great growth for Estee Lauder at 48, with the current yield on AAA corporate bonds at 4.75, giving an intrinsic value of 155. As we can see here, lower than the current trading price, showing some signs of overvaluation. We then have companies in a similar sector and size, L'Oreal, Procter & Gamble, and Coty. With their stock price and EPS, we get the PE multiples, average multiplied by the earnings per share to give a multiples valuation model of $131, showing some significant overvaluation to even the current share price. Now, the dividend discount model, we have the yearly dividends year on year. Average growth rate at just under 12%, very, very strong. Forward looking, I've gone for 7%. You could argue slightly higher. You could probably also argue slightly lower if you wanted to be more conservative. If you do want to play around with these growth rates, do pick up a copy of this model in the comments below. DDM price based on the 7% is coming at $282. Right there at the 52-week high, showing some significant upside to that current share price. And then finally, we come onto the discounted cash flow model, free cash flows year on year. Average growth rate is 16.4. We've estimated fairly in line essentially with the last 10 years. And using our discount rate, we have the present value of future free cash flows and terminal value. Add the cash and cash equivalents, subtract the total debt, and we get to our equity value. Divide that by the shares outstanding to give a DCF price of $272. Again, showing some significant upside and right there towards that 52-week high. Now, the intrinsic value is essentially the average of the 4 models we have just run through. And as always, if you do enjoy the content, do hit that like button, do subscribe for more content on your doorstep. Intrinsic value coming in around $210.26, with Wall Street essentially forecasting the price to go even higher than what we've calculated at $235. Now, current share price right there at that 52-week low. Typically, margin of safety, I'd be looking for around 10% for a strong company, wide moat, nice financial metrics and forward guidance. So if you were looking at 10%, your acceptable buy price would be around $189, which shows it is a current buy at these prices. Personally, I would rather go for around 20% for this industry, which has a lot of competition and very, very small margins as we saw. So in terms of the margin of safety, I would be looking at around 20%. Which in all honesty is right there at the current price. I have it on my watch list at around $168 and will start to dollar cost average in, as this will be a new essential stock in my portfolio. As always, do let me know your thoughts in the comments. Are you a shareholder of Estee Lauder? Are you looking to buy or sell, or are you purely on the sidelines? And as always, don't forget to like, subscribe, catch you on the next episode, and take care. Have a great day. Bye-bye.